Hello everyone, welcome to BISP solution. So today's topic is we'll see Accounting Standard Codification 470 and 505. Accounting Standard Codification 470 stands for debt and Accounting Standard Codification 505 stands for equity. So 470 is a section of US GAAP, that is US Generally Accepted Accounting Principle, which provides guidance on accounting for debt, including classification, modification, extinguishment, and specific debt instruments. It outlines how entities should classify debt on their balance sheets, account for debt with options like conversions, and handle troubled debt restructurings. The standard also guides the treatment of debt modification versus extinguishments and the process for accounting for debt exchanges. There are some key aspects of Accounting Standard Codification 470. First, it is debt classification. It dictates how to classify different types of debt, including putable debt and the debt that becomes due on demand. We'll also see here debt modification. It also explains about debt modifications and extinguishments. That is, it specifies when a debt exchange is considered a modification versus an extinguishment, which has significant accounting implications. This involves determining if the terms of the old and new debt instruments are substantially different or not. Here it also explains the debt with features, like it provides guidance on accounting for debt instruments with conversion options, put or call options, and other features that require separate accounting under Accounting Standard Codification 815 for derivatives. So here it covers Accounting Standard Codification 470-10. It explains classification of specific obligations, example refinancing of short-term obligations to long-term, callable and indexed debt, sale of future revenue, increasing rate debt, etc. Then we'll hear the next subtopic is (470-20), which provides accounting and reporting guidance for debt with specific conversion features. For example, debt instruments with detachable warrants, interest forfeiture, convertible securities, and induced conversions. Then Accounting Standard Codification 470-30. It tells us about the appreciation in the fair value of the mortgage real estate project, and the result of operations of the mortgage real estate project. Then 470-40. This subtopic provides guidance in determining whether a sale of the product is actually a sale or a financing arrangement. So if it is a sale or a financing arrangement. Then Accounting Standard Codification 470-50. It provides a modification of debt instrument. It provides the modification of the debt instrument should be accounted for as an extinguishment, or an exchange of debt instruments with the same creditor constitutes an extinguishment of debt. (60). This provides guidance on measurement, disclosure, derecognition, and implementation issues which concern the troubled debt restructuring by debtors. So now we will study about the debt restructuring. So here it will tell you about the standards, also tells you about transfer of assets. Transfer of assets will be on the basis of fair value of asset transferred minus net book value of asset transferred. or you can say closing value of the payable minus fair value of the asset transferred. So this is how you'll see how much is the transfer of asset. Now transfer of equity interest. So debtor gives the creditor stock of the company. So that's a transfer of equity interest. So in that case, transfer of equity interest. In this case, closing value of the payable or the current value of the payable minus fair value of equity transferred. This is the value. Then we will see modification of terms. Modification of terms means it will tell you the effects of the restructuring. They are accounted for prospectively. Example, lower interest rate, longer period to pay back the loan. That's a modification of terms. So this is your debt restructuring. You are restructuring the debt. Okay, so now we'll start with the second standard. So in this standard we have this much only. It tells you about these many topics. The second is 505, that is equity. So here under equity we'll see the equity terms. We'll also see the accounting standard codification. What does it say? 505 for equity, treasury stock, stock dividend and stock split. So as per the equity terms, here it will tell you the par value, that is, it is the stated value or the face value that you will say. Authorized, issued, and the outstanding shares. Issued means the shares which have been issued, or the repurchased stock, or the sold stock. Common stock means the basic ownership interest in a corporation who receive the ultimate benefits of success and bear the ultimate risk of loss. That's the common stock. Then we also study about the preferred stock, that is preference relating to the dividends. Liquidation but no voting rights, that the preferential dividend will be given according to the dividends. Liquidation, but it will not have any voting rights. Then what is we also hear many times about additional paid in capital. So it is the capital contributed in excess of the par value, that is in excess of the face value. Retained earnings. So equity term, in equity we also include the retained earnings, that is accumulated earnings or losses during the life of corporation before paying out the dividend. That's the retained earning. Now 505, this tells you about the overall. Then 505-20 talk about the stock dividends and or the splits. Then 505-30 talks about the treasury stock. Okay, so in overall it provides the guidance on equity related issues not addressed in other subtopics. 505-20, that is stock dividend splits, it provides guidance for both issuers and the recipients of the said stock. Then treasury stock provide guidance on entities, the repurchase of its own outstanding common stock and the subsequent retirement of those shares. Then accounting standard codification 505, this subtopic 50, it talks about equity based payment to non-employees. That means it provides guidance for the issuers and recipients of the said stock. Then 60 is talks about the spin-off and reverse spin-off. It addresses the distribution of non-monetary assets in such transactions. So now what's treasury stock? So treasury stock, so that means a corporation's own stock which is issued to the shareholders and subsequently which has been reacquired. So the treasury stock can be accounted for in two ways. First, we're talking about the treasury stock. It can be accounted for as like cost. It will give you first calculate the cost, that is the gain or the loss is calculated upon the reissue of the outstanding when to recognize the profit or loss on the treasury stock. So that's a par value. Now par value means the gain or loss is calculated upon repurchase. Cost, the gain or loss is calculated upon reissue. So the cost method is used approximately 95% of the time, whereas the par value method is used 5% of the time by the entity. So there are two, it can be accounted in two ways, either cost method or the par value method. So cost method 95% it will be used, whereas the par value remaining 5% times. Cost method means gain or loss is calculated upon repurchase when you are repurchasing the stock. But par value say gain or loss is calculated upon, this is calculated upon repurchase, and this cost, according to the cost method, this is calculated upon regain, or you can say reissue. So cost method says gain or loss upon reissue, and par method says gain or loss upon repurchase. So this is 95% time use, mostly, that means 95% this method is being used, and 5%, remaining 5%, this par method is being used. Now suppose according to the cost method, that is on the reissue method. So what you say, suppose original issue price, as per the original issue, suppose 10,000 shares at the 10 rupees par value common stock, it was sold for 25 per share. So 10,000 shares of 10 rupees per share was sold for 25 rupees per share. Okay, so now what will be the entry? So we will say cash account debit 25. Now how we will enter the amount? So 25, it was sold for 25 and 10,000 shares. $25 into 10,000, so it will be 2,50,000, and we'll credit common stock because we are issuing the shares, and additional paid in capital because initial capital was 10, so remaining will be captured in additional paid in capital. So that means common stock, it was 10 into 10,000 and 15 into, that is the extra margin that you earned, that will be encountered here under additional paid in capital. So this is your entry. Now if you are buying back in above issue price, suppose if you are buying back it, so that means 400 shares were suppose repurchased at 30. 400 shares now repurchased, that means you have paid up capital, or the initial capital was 10, you have sold it at 45. Now you are buying back 400 shares at 30 rupees each. So what will be the entry? So you will say treasury stock, because now you are buying back. So treasury stock account debit, so you are buying back at 30 rupees 400 shares, so you record it for 12,000 2, and you are paying the cash, so you will record it at 12,000, right? Now suppose if you are reissuing at above cost, so you will have, if you reissue at above cost, that means you are suppose 200 shares were repurchased for 30 and were resold for 35. That was out of this 200 shares that you purchased for 200 shares you purchased for 30 and sold for 35. So in this case you will say cash account, out of 400 we are selling back 200 shares, so cash account debit. So you can say 200 shares into 35 to treasury stock, because we have debited the treasury stock, so treasury stock account credit. So 200 shares into 30, and the 5 rupees profit that you have earned on 200 shares, that is 1000, you will record it with, you can say profit on gain or profit on sale, anything. Okay, or you can say here, instead of this you can say the additional capital, additional paid in capital. This is that APIC. Okay, additional paid in capital. So this is how you record the as per the cost method, you book the journal entries. Now as per the par value method, in the similar case, this is the original issue. Now as per the par method, that is the second method. Now in this case, suppose 1000 shares were issued at 10 par value common stocks, it was sold for 15 instead of 25, it was sold for 15. So in that case you will record the entry as okay, so cash account debit, it was 15,000 because it was sold for 15 rupees, 10 rupees value was sold for 15, so cash will come of 15. Common stock will be credited because 10,000, 1000 into 10, and here 5,000 is your profit, that is additional paid in capital. Now if you are buying back, so issue price, suppose now 200 shares were repurchased for 20, you have sold at 15, here you have sold at 15, now you are repurchased at, that means you can say buyback at 20 per share. Now you were buying back suppose 200 shares, so you can say treasury stock account debit, because you are buying back so here you will record, so 200 shares, now you are buying back, so 200 into, in this case it will directly not say 200 into 20 because initial cost was 200 into, that is the fair value was 10, so par value, so it will consider the par value. Okay, here in this case par value was 10 per share. Okay, and sold at 15, so in this case now it will say treasury stock debited with 2000, the profit that it has earned initially. Okay, so it was now, that is now cost, so that will remain to be 1000, that means 200 into 10, because we have repurchased at 20, bifurcate into 10 and 10, 10 is the additional cost and 10 is the par value, so 10 is the par value, 10 is the additional cost. And here we will also debit the retained earning, if not enough then we will reduce it with the 1000. Now cash will be paid off 4000. This is how you will do. Now buyback, now if you are buying back below the issue price, that was above the issue price, now if you are buying back below the issue price, this 200 shares are purchased at 10 per share. Okay, so in that now treasury cost will be debited with 2000, 1000 will be additional paid in capital, and this 1000 that you have earned incurred as cost, you will credit this, and the cash will be credited with 2000. The same entry will be passed in that case. Yeah, so this is how you record according to the both the methods. Now suppose reissue shares, which is treated as like a original issue. So in that case you can say 150 shares repurchased for 20, now they were resold at 22. So in that case cash account debit will be there for, so 150 shares, they were repurchased and sold for 22. 3300 will be cash account debit to treasury stock. So treasury stock will be, that means 150 into 10 was the par value, so 150, 1500 will be this, and the remaining, that is 750, will be a again additional paid in capital. Okay, and now suppose if 150 shares repurchased for 20, they were sold at loss, that is at 15. So in that case, you will pass the entry, this was purchased for 20 and sold at 22. Now reversal is the case, purchased for 20, sold at 15. It was repurchased, not purchased. Okay, reissue shares. So you can say now cash, of course, if you are selling it to cash account debit, it will be 150 into 15, that is 2250. Now to treasury stock, that is treasury stock account credit, it will be 150 again into par value, and the remaining, that is 2250 minus 1500, 750 will be APIC. Okay, that is a common stock, the remaining value. Okay, accordingly it gets varied. So anyway, treasury stock will be always, it will be shown at the par value. And last we will study about the stock dividend. Okay, so treasury stock we have covered. Now we are seeing about the stock dividend. So stock dividend means it's a distribution of additional shares of a company's own stock to its shareholders. Small stock dividend, that means the fair market value method is used, wherein the retained earnings is reduced by the fair market value of the shares, that is net price of the stock is not affected. And large stock dividend is means per value method is used, wherein the retained earnings, it is reduced by the per value of the shares, that is it will reduce the net price of the share. Now suppose if we take an example, you can say, suppose Copper Corporation has 10,000 shares of 10 par value common stock outstanding. The company declares a stock dividend of 800 shares when the fair value is 20. So it's stock dividend of 800. I'll just note down some important points. So like 10,000 shares at 10 per value, then stock dividend of 800 shares when the fair value was 20 per share. So 800 divided by 10,000 is equals to 8%. Okay, which is considered as small stock dividend, because 8% small stock dividend is reduced, that means a small percentage. So small stock dividend will be if it is less than 20 to 25%. If it is greater than 20 to 25%, that means large stock dividend. So this is less than 20 to 25, that is 8%, so small stock dividend. In this case, you will have you'll pass the entry as retained earnings account debit. So retained earnings account debit will be there with you can say 10,000 into 0.08, that's a 16,000. That means 10,000 into, this much was stock dividend, so 10,000 into 8% into 20 rupees per share. Now to common stock account credit. So common stock will be 10,000 into 10 into 0.08, that is 8,000. To additional paid in capital, that is APIC. So it will be, that will be the remaining 8,000 difference, that is an additional amount. That's a C. 10 we have purchased at 10 and sold at 20. Okay, so 8% was the stock dividend. So that is only at 10 you have recorded at par value, and then the 10 was APIC. Now if you take another case like large stock dividend, so that's a last case where suppose Zinc Corporation declares a 30% stock dividend on its 10,000 shares outstanding. On the declaration date, Zinc stock is selling at 22 per share. So 10 purchased and sold at 22 per share, and 30% stock dividend, 30% stock dividend was there, and 10,000 total shares were there, 10,000 shares outstanding. Okay, this is the correct. So total stock dividend will be 10,000 into 30%, so 0.3, which will be 3,000. So value of 3,000 shares, which is issued at par value of 10, so selling price will be 3,000 into 10, that is 30,000. So in this case now, to record the declaration of stock dividend, to record it at par, we will say retained earning account debit. So it will be recorded with 30,000. To common stock account credit, which will also be recorded at 30,000. Okay, that is at par. To record the distribution of stock dividend at par, so that's only the same entry that will be done. So it will be common, and first we have recorded the distribution of stock dividend at par. Now we will record the distribution of stock dividend at par. So earlier this is the declaration of stock dividend. Now if you are distributing the stock dividend, so it will be common stock. Now it will be debited. Earlier it was credited, so it will be debited with 30,000 to capital stock account credit. Stock credit with 30,000. Okay, this is the case. So this is your large stock dividend, and this is this is your small stock dividend, that is less than 20-25%, and this is greater than your large 20-25%, that is large stock dividend. Now what is stock split? Stock dividend we have seen, treasury stock we have seen. Now the next is stock split. So it is issuing additional shares of its own stock to the current shareholders and reducing the par value per share proportionately. So the stock split usually brings no changes to the retained earnings or to the shareholders' equity. If it is increased or if it is decreased, it will bring no change. So reverse stock split occurs when the number of shares outstanding, they are reduced and the par value is increased proportionately. So like suppose before the split, common stock was 10,000 shares outstanding at ₹10, so it will be 1 lakh stated capital. After the split, common stock shares was suppose 20,000 shares and they were issued at 5 per share. So stock split will be like earlier there were 10,000 shares and the value was 10 par value. Now after the stock split, like this 10,000 is broken into 5. So the shares we have to issue at 20,000. So 20,000 shares at 5 per value. Okay, because this gets broken up. The 10 rupees value gets broken up half. So it will be 20,000 and the shares will get double, right? Of course. So it will be, the value will remain same. That is 10,000 into 10. And here also it will be 20,000 into 5. Okay, so value will not change. Anyway, it will be same. So it will be no change to the capital. That's why it says stock split value brings no changes to the retained earnings or to the shareholders' equity. A reverse stock split occur when the number of shares outstanding, they are reduced and the par value is increased proportionately. Okay, so this was your stock split. So these all things we studied in Accounting Standard 505 equity. What is the stock split? Now what's the treasury stock and what's the reverse stock split, stock dividend. So these all were the topics with the large stock dividend, small stock dividend, all those things. Yeah, so that's all for today. We covered the two standard codification, that is 470 and 505. Now if you have any questions, please contact BISP Solutions. Thank you all for your time. Thank you.